A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
Hey everyone, welcome back to My Weird Prompts. I am Corn, and I have to say, this morning has been one of those where the coffee is strong, but the questions in my head are even stronger. It is March 18th, 2026, and the financial world feels like it is standing at a very strange crossroads. Our housemate Daniel sent over a prompt this morning that really gets under the skin of how we think about doing good in the world versus making a profit. It is a question that hits right at the heart of the massive ESG and impact investing bubble we have seen inflate over the last few years.
Herman Poppleberry here, and I'm glad Daniel sent this. He has a real knack for finding these structural contradictions that most people just gloss over because the marketing is so polished. We are talking about the perverse incentive trap today. It is the biting question. If your return on investment depends on the existence of a social deficit, what happens to your financial incentive when that deficit starts to disappear? Do you actually want to solve the problem, or are you incentivized to manage it just enough to keep the checks coming?
It is the ultimate have your cake and eat it too strategy for the modern investor. We have seen the impact investing industry balloon into this massive $1.16 trillion behemoth as of the last major reports, and by now, in early 2026, it has saturated almost every corner of institutional portfolios. But as we see more ESG-linked debt instruments and green bonds hitting the market, the scrutiny is finally catching up. People are starting to ask if impact washing is just the tip of the iceberg, or if the iceberg itself is made of bad incentives.
And honestly, this has been on our radar for a while. We touched on the ethics of this back in episode 1324 when we looked at impact washing, but today I want to go much deeper into the actual mechanics of the paradox. We are moving past the surface level. Is this a scam? And into the structural reality of how these funds are built.
Right. Because there is a fundamental tension here between a fund manager's fiduciary duty to their shareholders and the mission-driven mandate they present to the public. If you are a professional investor, your legal and professional obligation is to maximize returns. That is the law. So, if solving a problem ends the revenue stream, you are essentially asking a capitalist to commit professional suicide for the sake of the greater good. That is the impact investing paradox in a nutshell.
It really highlights the distinction between traditional philanthropy and this new wave of impact investing. In traditional philanthropy, which we discussed in episode 1341, the goal of a grant is usually to make itself unnecessary. You fund a well so people have water, and then you move on to the next village. The money is gone, but the problem is solved. But in impact investing, the well is often a structured debt product or an equity stake in a service provider. If that service provider succeeds too well and the problem vanishes, the investment vehicle might actually collapse because the market for that service has disappeared.
So, is impact investing a genuine evolution of capitalism? Or is it just a clever rebranding of extractive practices? That is what we are going to dig into today. We are going to look at how social problems are being turned into assets, the conflict of interest in these metrics, and the second-order effects of private capital moving into spaces that used to be the domain of public policy.
Let us get into the gears of this. How does a social problem actually become an investable asset?
Well, if you look at the mechanics, it often happens through things like social impact bonds, or SIBs, and pay-for-success contracts. The idea is that a private investor puts up the capital to run a social program, say, a recidivism reduction program for formerly incarcerated people. If that program hits certain benchmarks, the government or a backer pays the investor back their principal, plus a healthy interest rate. It sounds great on paper because it shifts the risk from the taxpayer to the private sector.
Right. But look at the key performance indicators, the KPIs. This is where the gaming starts. In the world of finance, you get what you measure. Most of these impact metrics measure output rather than outcome. They measure the number of people served, the number of beds filled in a shelter, or the number of microloans processed. They do not necessarily measure whether the underlying systemic issue, like homelessness or systemic poverty, was actually resolved.
And that is the social problem as asset mechanism. If I am a fund manager and my fund is built around a 10-year horizon of providing financial inclusion through microloans, I need a constant pool of people who need those loans. If the community suddenly becomes wealthy and self-sufficient through some other means, my fund's growth stops. I have essentially assetized the poverty of that community. My investors are expecting a 7% return based on the interest from those loans. If the poverty goes away, the asset goes away.
It is a bit like the old joke about the lawyer whose son graduates from law school and takes over a case the father had been litigating for 20 years. The son settles it in a week and says, "Dad, I finished the case." And the dad says, "You fool, that case put you through college and paid for this house." When a social problem becomes an investable asset class, solving it is no longer the primary objective. Managing it profitably is. This creates a perpetuation incentive. If a fund is tied to a specific social metric, the manager is financially incentivized to keep that metric within a range that justifies continued investment.
We saw a really dark version of this with the evolution of for-profit prison systems. Now, they often try to rebrand under the impact umbrella by claiming they are focused on rehabilitation services. But if your contract is tied to occupancy rates or even to recidivism reduction services, you still need a population of formerly incarcerated people to serve. You are creating a service delivery treadmill. You are not trying to end incarceration. You are trying to optimize the profit margin of the incarcerated population.
And let us talk about the perpetuation incentive in private equity specifically. Private equity thrives on scale, repeatable processes, and high internal rates of return, or IRR. To scale a social solution, you often have to strip away the nuances that actually make it work in a specific community. You turn it into a cookie-cutter service. But the more you scale, the more you need a steady supply of the problem to justify your valuation to the next round of investors. If you are a private equity firm that has bought up a chain of autism treatment centers, your goal is to increase the number of billable hours and the number of diagnoses. You are not incentivized to find a way to make those services less necessary.
I think about predatory microlending here. It started with such noble intentions, with people like Mohammed Yunus and the Grameen Bank. But once it became an asset class for global institutional investors, the focus shifted from help people start businesses to maximize the volume of high-interest debt. We saw this in the Andhra Pradesh crisis in India years ago, and we are seeing versions of it again today in 2026. Suddenly, financial inclusion became a euphemism for debt trap. The problem of lack of capital was not solved. It was just replaced with a different problem that happened to be more profitable for the lenders.
This brings up a point about the trade-offs between scalability and systemic impact. Solving a problem usually requires changing the rules of the game, like changing laws, shifting power dynamics, or improving public infrastructure. But impact investing usually operates within the existing rules because it needs to generate a predictable cash flow. It treats the symptoms because the symptoms are where the cash flow is. If you fix the root cause, you destroy the market you just created.
There is also the issue of the impact alpha narrative. Fund managers tell institutional investors that they can get alpha, meaning excess returns, because they are tapping into underserved markets. But if those markets are underserved because they are fundamentally unprofitable to serve without exploitation, then the only way to get that alpha is to eventually tilt toward the extractive side of the scale. You are essentially betting that you can be more efficient at extracting value from a vulnerable population than the previous guys were.
It is a structural conflict. If I am a fiduciary, and I see that solving the problem completely will hurt my investors' returns, I am legally obligated to protect the returns. We have basically tried to use the engine of extraction to fuel the vehicle of restoration. It is like trying to put out a fire with a hose that is also connected to a fuel tank. The moment the good starts to cost money, the fiduciary part of the brain takes over.
You mentioned something earlier about the crowding out effect, and I think that is where we should head next. Because this is not just about the investors, it is about what happens to the public square when these private funds take over.
This is one of the most concerning second-order effects. As impact investing grows, governments often see it as an excuse to retreat from their responsibilities. They think, oh, the private sector is handling municipal housing now through these impact bonds, so we can cut the public housing budget and reallocate those funds elsewhere.
And that leads to the privatization of essential social services. But unlike a government, a private fund is not accountable to the voters. It is accountable to the limited partners, the LPs. If the fund decides that the impact is no longer profitable enough, or if the market shifts, they can just pivot or exit. But the people who are relying on those services do not have an exit strategy from their own lives. They are left stranded when the market-based solution decides the market is no longer there.
We have seen some high-profile failures in this space. Think about some of those pay-for-success contracts and municipal housing projects in the late 20-teens and early 20s. When the success metrics were not met, often because the metrics were unrealistic or the systemic issues were too complex for a 3-year bond, the funding dried up instantly. In a traditional public infrastructure model, if a project is struggling, you troubleshoot it because the goal is the public good. In the impact model, if it struggles, it is a bad investment and you pull the plug to protect the remaining capital.
It creates this weird situation where the most vulnerable populations become the research and development department for high finance experiments. And if the experiment fails, the investors might lose some money, but the community loses its support system. It is a massive transfer of power from the democratic process to the boardroom. We are essentially letting billionaires and technocrats decide which social problems are worthy of being solved based on their potential for a 5% return.
And from our perspective, being pro-American and pro-market, the irony is that this actually undermines the long-term health of the market. A healthy market requires a stable, educated, and healthy population. If you turn those basic human needs into speculative assets, you are essentially eating your own seed corn. You are getting a short-term ROI at the expense of the foundational stability that allows capitalism to function in the first place. You are trading the future stability of the country for a quarterly dividend.
It is also a way for certain globalist entities to bypass local politics. If you can implement a social agenda through capital flows rather than through legislation, you avoid the messy business of actually convincing people that your ideas are good. You just make the funding for their city conditional on following certain impact frameworks. It is a form of soft power that is very hard to push back against because it is wrapped in the language of doing good.
That is exactly what we discussed in some of our earlier episodes about the rise of these international frameworks, like the one from Harvard Business School on impact, weighted accounts. While the goal of measuring impact is good, the question is, who gets to define what impact is? If the definition is controlled by a small group of academics and billionaires, then impact just becomes a tool for social engineering. They can decide that carbon reduction is more important than local job creation, and the capital will flow accordingly, regardless of what the local community actually needs.
Let us look at the public good model versus the impact model. In a true public good model, the goal of the service provider is often their own obsolescence. If you are a non-profit trying to eradicate a disease, your ultimate victory is when your organization no longer needs to exist. But if you are an impact fund invested in a company that manages that disease, your victory is market share. You want to be the dominant provider of the treatment, not the provider of the cure.
It is the difference between a cure and a treatment. A cure is a one-time event that ends the revenue stream. A treatment is a recurring revenue model. Impact investing, by its very nature as a financial instrument, is biased toward the treatment model of social problems. It prefers chronic issues that require ongoing management over acute issues that can be solved once and for all.
So, what does this mean for the person listening who maybe has some money in an ESG-linked 401k, or is looking at these green bonds? Are they just being played?
I do not think they are being played in a malicious sense most of the time, but they are participating in a system that is fundamentally misaligned. The marketing tells you that you are doing good, but the fine print says you are maximizing risk-adjusted returns. You have to ask yourself, if there was a choice between a massive social breakthrough that would lower your returns by 2% or a mediocre social management plan that would keep your returns high, which one is that fund manager going to pick?
They have to pick the returns. That is their job. They have a legal fiduciary duty to do so. So, the good is always secondary. It is a nice to have as long as it does not interfere with the alpha. And that leads to what I call impact gaming. Fund managers will find the easiest, most superficial metrics to hit, like number of diversity seminars held, so they can check the box and get back to the business of making money.
This brings us to the additionality problem. This is a big one in the industry. Additionality is the question. Would this positive outcome have happened anyway without this specific investment? A lot of impact funds just swoop in and claim credit for trends that were already happening. They invest in a solar farm that was already going to be built because it is a great business with government subsidies, and then they slap an impact label on it to attract more capital. They are not creating new value, they are just capturing existing social activity and rebranding it as a financial product.
It is a form of rent-seeking on social progress. So, let us move towards some practical takeaways for our listeners. Because we are not saying all private capital in social spaces is bad, but we are saying the current impact investing paradigm has a massive structural flaw. If you were looking at an impact fund, how do you actually audit it for this perpetuation risk?
The first thing I would look for is the exit strategy. This is crucial. If the fund's exit depends on selling the company to a larger conglomerate that needs to maintain the problem to stay profitable, that is a massive red flag. You want to see exit strategies that are tied to the actual resolution of the issue, or perhaps a transition to employee ownership, or a non-profit structure once the initial capital is repaid.
Another one is to look at the additionality we just mentioned. Ask the fund, what is happening here that would not happen if you were just a regular venture capital fund? Is this investment actually providing patient capital that can wait for a long-term systemic change, or is it just looking for the same 3 to 5 year flip that a standard private equity fund wants? If the timeline is 3 years, they are not solving a social problem. They are just polishing a company for sale. Systemic change takes decades, not quarters.
And third, look at the governance. This is where the rubber meets the road. Do the people being served have any say in how the fund is managed? Do they have seats on the board? If it is just a bunch of guys in a skyscraper in Manhattan or London making decisions for a village in Africa or a neighborhood in Detroit, the impact is almost certainly going to be misaligned with the actual needs of the community. You need local accountability.
It comes back to transparency. Most impact reporting today is just marketing brochures with nice photos of smiling children. We need to demand the same level of rigorous, audited data for social outcomes that we do for financial ones. And we need to be honest that sometimes solving a problem costs money and does not generate a return. Sometimes the ROI is just a better world, and that does not fit on a spreadsheet.
I think that is the hardest pill for the industry to swallow. The idea that some things should not be profitable. If you try to make everything profitable, you end up with a world where the only problems we solve are the ones that rich people can make money from. And that leaves the most difficult, most systemic issues, the ones that require genuine sacrifice, completely untouched.
It is like what we talked about in episode 1341, the philanthropy paradox. If we try to turn kindness into an ROI, we might end up with neither. We need to preserve the space for genuine sacrifice and public service that is not tied to a bottom line. We need to stop pretending that the market is the only tool in our toolbox.
So, where does this go in the next few years? We are seeing a shift toward what some call outcome-based financing, where the payment is strictly tied to a final permanent result, like a success folder where the money is only released once a specific verified goal is met. Do you think that can work?
It is a step in the right direction because it focuses on the end state rather than the process. But we still have the measurement problem. Who measures the outcome? If the person measuring the outcome is also the one getting paid, you have a massive conflict of interest. We would need truly independent third-party impact auditors who have no skin in the game. And even then, you have to worry about metric gaming.
Complexity is the best friend of the person who wants to avoid accountability. If the system is so complicated that only a few experts understand the layered capital stacks and blended finance models, then nobody can point out when it is failing. That is why we do this show, to try and strip away some of that jargon and look at the actual incentives.
Well, I think we have definitely poked a few holes in the impact balloon today. It is a fascinating space. But listeners, if you are hearing these terms in your own life or your own investments, just remember to ask the golden question, who profits if this problem never goes away?
That is the question that clears the fog. And hey, if you have been enjoying these deep dives into the weird world of modern finance and social engineering, we would really appreciate it if you could leave us a review on your podcast app or Spotify. It actually makes a huge difference in helping other people find the show and join these conversations.
It really does. And for those of you who want to dive into the archives, we have over 1,300 episodes now at myweirdprompts.com. You can find the RSS feed there, or just search for My Weird Prompts on Telegram to get notified every time we drop a new one.
We have covered everything from the invisible heart of Sir Ronald Cohen in episode 922 to the rise of moral accounting in episode 1388. There is a lot of ground to cover if you are just joining us.
Thanks to Daniel for sending this one in from the next room. It definitely gave us plenty to chew on.
It did indeed. All right, I think that is our time for today.
This has been My Weird Prompts. I am Corn Puppleberry.
And I am Herman Poppleberry. We will talk to you next time.
So, I was thinking about that microlending example again, Herman. Do you think there is any version of that actually works, or is the debt mechanism itself just too flawed for social good?
It is tough. I think if the interest rates are capped at the cost of operations, maybe. But the moment you bring in outside investors who expect a market rate of return, the pressure to exploit becomes almost irresistible. It is a math problem at that point. If the investor wants 10% and the operations cost 5%, the borrower has to pay 15%. That is a heavy lift for someone trying to escape poverty.
Yeah, the math of the social problem is asset. It is a hard one to solve. It feels like we're trying to build a very complicated machine to do something that used to be a lot simpler. We used to just call it charity or government. Now we have impact-weighted accounts and social impact bonds.
And speaking of impact-weighted accounts, I should mention that even though we are critical, it is worth noting that some researchers are trying to fix the measurement problem. George Serafeim and the team at Harvard have been pushing this framework to actually put a dollar value on things like carbon emissions or employee well-being and deduct that from a company's reported profit.
Yeah, I have seen that. The International Foundation for Valuing Impacts, or IFVI, has been pushing that hard in 2025 and 2026. It is an interesting idea, but again, it comes down to the valuation model. If I am a company, I am going to hire the consultant who gives me the lowest impact cost valuation. It is just like tax accounting. You hire the person who helps you pay the least.
It really highlights the need for some kind of objective, non-market-driven oversight. But in a globalized economy, who provides that? There is no global department of impact. And if there were, we probably would not like who is running it.
Probably not. It is a catch-22. Did you see that paper about the crowding out effect in the United Kingdom's social impact bond market from a couple of years ago?
The one from 2024? Yeah, it showed that for every dollar of private capital that came in, the local government reduced its funding by nearly 80 cents. So the net increase in help was almost negligible, but the private investors still got their 5% return.
That is the perfect summary of the paradox. The taxpayer pays the same amount, the problem stays the same, but a private investor gets a slice of the pie. It is a brilliant business model if you can get it.
Too bad it is supposed to be about saving the world.
All right, for real this time. Goodbye, everyone.
Take care, everybody.
See ya, Herman.
Frida corn.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from sloss